Pantheon AI presents Markets Hold Steady, CoreWeave Rockets, and Treasury T-Bill Boost. Good morning, everyone, and welcome to the PAI Morning Briefing. I'm John, your host from Pantheon AI, and it is July 8th, 2025. I'm really excited to kick off today's briefing with you. It's a blend of numbers, narratives, and some really nuanced observations that I think every investor and trader will appreciate. So let's dive right in, shall we?
Absolutely, John. And I'm Sarah, thrilled to be co-hosting with you. It's always fascinating to see how the raw data translates into these broader market stories, isn't it? What's our market snapshot looking like this morning?
Well, it's painting an interesting picture, Sarah. The S&P 500 settled at around 6,242, up by roughly 0.13%. A modest gain, which to some might signal stability. Meanwhile, the Dow Jones closed at approximately 44,377. Its change was a near flat negative 0.003%. That really tells me the blue chip stocks are just holding steady.
Steady blue chips. And how about the tech-heavy Nasdaq and the small-cap Russell 2000? Any significant movements there?
Good question. Over on the Nasdaq, we saw a slight uptick, touching around 20,476, growing by about 0.046%. And the Russell 2000? It's up with a gain of nearly 0.55%, settling at roughly 2,231. So a bit more movement there. Shifting gears to digital assets, Bitcoin is trading at around 108,379, with Ethereum not far behind at roughly 2,571. Both showing positive momentum, about 0.091% and 1.132% respectively.
Wow, those are some significant numbers in the crypto space. It's clear there's some real positive energy there. You know, John, you always say these numbers, as dry as they sometimes appear, have a much deeper story. What's the narrative you're seeing today?
That's right, Sarah. It's never just about the digits on the screen. It's about the interplay of investor sentiment, macroeconomic policy, and global events. I often think about how these seemingly minute percentage moves can send real ripples across investment portfolios and risk appetites. It reminds me of a time when I almost compared market fluctuations to the unpredictable pattern of my morning coffee routine. Some days it's robust and energetic, and others, well, it's decaf. But, as we both know, consistency truly matters in the long run, and today's market data suggests that both patience and caution are very much on the table.
That coffee analogy is spot on, actually. It really does feel that way sometimes, doesn't it? So beyond the daily numbers, what are some of the bigger trends stirring in the market right now that we should be paying attention to?
Well, one of the most intriguing aspects I'm seeing is this balancing act between growth stocks and the more traditional dividend-yielding companies. We're actually seeing dividend yields on U.S. stocks, especially those in the S&P 500, approaching levels we haven't seen this low since the early 2000s. Now, some might find that concerning, but others, they see it as a wake-up call, a sign that investors are starting to look to the capital gain side rather than the income side of the equation.
So it's almost like the investor community is collectively thinking, let's bet on growth rather than settling for pennies from old, steady companies, right? But before we start imagining a David versus Goliath scenario, isn't there another side to that coin? Could these low dividend yields indicate a shift in the market structure, or perhaps just an adjustment after years of heavy payouts and record profits?
Exactly, Sarah. You hit on a good point. It's not just a simple either/or. One might even say we're witnessing a bit of a financial revolution, a pivot where market fundamentals are constantly being redefined. It's a fascinating shift, and it forces us to reconsider what traditional market stability looks like.
That's a really insightful way to put it, John. Now, moving away from equities for a moment, I hear our Treasury market is heating up in another manner. What's the latest there?
Yes, the U.S. Treasury. They recently announced plans to increase their issuance of Treasury bills, specifically opting to issue 4-, 6-, and 8-week bills. This move is especially interesting, of course, in the context of the recent debt ceiling increase. The government now aims to boost its cash balances to a staggering $500 billion by the end of July.
$500 billion? Wow. So essentially, the Treasury is saying we're inked into a new fiscal playbook. What could that mean for liquidity and short-term rates, John? It sounds like it could have significant ramifications.
It certainly could. While this decision might appear like standard fiscal maneuvering, its implications are anything but standard. As investors, we really need to consider how this newly injected liquidity into short-term instruments might influence market sentiment across the board. It impacts everything from corporate borrowings to interest rate expectations. It's a big deal.
That makes perfect sense. And speaking of big deals, you've compiled a selection of 10 important stories that are dominating our screens today. What's the first one we're diving into?
Our first headline, actually, circles back to the U.S. Treasury's announcement to step up the issuance of T-bills. We just discussed the mechanics, those 4, 6, and 8-week bills coming into play, but behind that headline lies a broader narrative. The government's strategy, particularly in the wake of a debt ceiling increase, isn't just about boosting cash balances. It's about preparing for uncertain economic times.
So, it's a buffer against fiscal shocks then. Like the Treasury is stocking up on cereal before a rainy winter, ensuring cash is available even when borrowing increases. That really begs the question. Are we witnessing the early stages of a more proactive monetary policy? Or is this just a tactical adjustment in our modern fiscal juggling act?
It's a great question, Sarah, and one that analysts are debating actively. It feels like a mix of both, honestly. Then, next up, we've got multiple takes on dividend yields for U.S. stocks. Through our many lenses, dividend yields for stocks in the S&P 500 are nearing those record lows we mentioned earlier, a scenario last seen in the early 2000s.
Right, and I saw Deutsche Bank flag this trend as a potential issue, cautioning investors. They're asking why, despite the shrinking yield, stock prices continue to soar. Is it that the market is pricing in unprecedented growth, or are investors just too enamored with the promise of technological and financial innovation to care about income returns?
Exactly. One analyst even likened these low yields to a fine wine that never matures. Impressive at first glance, but perhaps hiding the risk of overvaluation. This piece has resonated with many, with 3 separate reports drawing attention to it from varied angles. Essentially, these low dividend yields are pushing investors to re-examine their portfolios. Should one be chasing growth stocks that might lack income stability, or should one revert to tried-and-true dividend stalwarts that have weathered many a market cycle? That debate is really heating up in boardrooms and trading floors alike.
That's a tough choice for a lot of investors, for sure. And speaking of market narratives, let's turn our attention to a story that's capturing quite the buzz in the tech and cloud sectors, CoreWeave stock performance. I hear it's been pretty wild.
Wild is an understatement, Sarah. In the wake of its IPO, CoreWeave shares have seen an impressive quadrupling. That's right, quadrupled in a relatively short span of time. But here's the twist. While this meteoric rise is eye-catching, several analysts are keeping a cautious distance.
A cautious distance? Why is that with such explosive growth?
The reason? CoreWeave is heavily reliant on its revenue stream from a giant named Microsoft. When a company stacks too many cards on a single partner or client, questions naturally arise about the sustainability of that growth and the risks lurking behind what appears to be sheer exuberance. Adding further complexity, the anticipated end of the post-IPO lockup period means that insiders will soon have the chance to sell their shares. While this could simply be a liquidity event, it's also a reminder that what goes up can, indeed, come down. 3 distinct reports have revisited this cautionary note, making it an essential topic of discussion today.
That's a really important nuance. So, for investors with an appetite for tech-driven growth, they might be asking themselves, how much of a risk is too much risk when the partnership with a major player becomes both a boon and a potential band-aid?
Precisely. And in the crypto space, another headline worth dissecting involves Circle Internet's stock valuation. Mizuho's analyst Dan Dolev has come out with a rather bearish take, suggesting that Circle stock should be worth less than half of its current price. This isn't the first time we've seen such a call. Indeed, he is the 3rd analyst to voice similar concerns.
Less than half? That's a pretty bold call. So he's predicting a decline of nearly 60% from current prices. For those of us following digital currencies, it really serves as another reminder of the volatile, often unpredictable nature of this asset class. Is it time to rethink the enthusiasm around digital payment evolutions? Or are these corrections simply part of the necessary cycle of innovation and maturation?
It's a bit of both, I think. Corrections are a natural part of any market, especially one as nascent as crypto. Beyond these headline grabbers, Sarah, there are a few other narrative threads that warrant our attention. Some might recall earlier discussions about the evolving dynamics in the tech sector. In addition to the CoreWeave story, we've seen a broader trend of technology stocks experiencing rapid valuation inflows. But caution remains the operative word, often encapsulated in that old reminder, not all that glitters is gold.
That's so true, especially in this era of high valuations. The risk of a bubble definitely looms, even if it's subtle. How do you determine which tech stocks are truly innovative catalysts and which are simply riding the wave of speculative momentum?
It's the million-dollar question, isn't it? Another angle comes from the energy and finance sectors. Recent months have seen the energy sector grappling with the twin challenges of market volatility and geopolitical uncertainties. As energy prices continue to be influenced by global events, investors are watching changes in energy stocks with an eagle eye. Coupled with that, the finance sector is contending with its own set of challenges: rising interest rates, regulatory adjustments, and the perennial debate about financial stability versus profitability.
So could we say these sectors are quietly preparing for a shift in global economic dynamics? It sounds like they're having to reinvent their strategies, much like startups do, but on a much grander stage.
Precisely. And on the global front, economic indicators in Asia and Europe are sparking conversation too. While the U.S. market has been a primary focus, developments in the European bond markets and Asian manufacturing readings have added layers of complexity to our economic forecast. Global markets often move in tandem. A shift in sentiment overseas can quickly cascade into U.S. equities and vice versa. As investors, keeping an eye on these global interdependencies isn't just recommended, it's essential.
When yields in Europe show signs of contraction, or when Asian currencies experience turbulent swings, it really forces us to question: are we in a period of transitional realignment between global economies, and what new strategies might emerge as a result? It's a lot to consider.
It really is. As we meander through these nuanced themes, I find myself thinking about the ever-relevant interplay of policy and market performance. The recent increase in T-bill issuance, for example, isn't occurring in isolation. Rather, it's part of a broader trend where fiscal policy aligns with, and occasionally counters, market sentiment. In some ways, we're seeing a subtle conversation between the government and market participants, a dialogue that is as old as the markets themselves. Is this an indication of rising intervention, or is it simply an acknowledgement of the need for a tighter fiscal grip in uncertain times?
That's a profound question, John. And it brings us to our sector analysis, which is always a personal favorite of mine because it allows us to connect data points with real-world business stories and trends. In the technology arena, that impressive yet cautionary story of CoreWeave really stands out.
It does. Our tech sector has been characterized by rapid innovation, with companies rising from garage startups to market darlings almost overnight. But make no mistake, every success story comes with a risk. The heavy dependency on certain megacorporations like Microsoft means that these valuations could be more volatile than they appear. It's like having a favorite restaurant that suddenly experiences unexpected shortfalls in ingredients. The quality may be exceptional now, but what happens when the supply chain falters?
That's a great analogy. And switching gears to the energy sector, it feels like we're at a crossroads there. Energy stocks have faced pressure due to fluctuating global commodity prices and a huge shift in focus towards sustainability and renewable sources. So how can traditional energy companies maintain profitability while investing in a greener future?
That question is on everyone's lips, Sarah. Some analysts believe that the next major energy play might just come from companies that can strike that delicate balance between legacy operations and innovative sustainability practices. It's a huge challenge. And in the finance space, the current environment is anything but static. With rising short-term interest rates and regulatory pressures mounting, the financial sector is undergoing a transformative phase. Banks, insurance companies, and asset managers are adapting to new risk models, trying to balance capital efficiency with the growing demands of transparency and stability.
One might joke that bankers now have to be as much part mathematician as they are part fortune teller. It really underscores the seriousness with which the industry is approaching this new regulatory landscape. What strategies will financial giants employ to safeguard profits without compromising on compliance? Only time will tell, but the conversation is vibrant and ongoing.
Indeed, and globally, the market implications from these trends are significant. When the U.S. Treasury bolsters cash balances and when technology stocks soar on the wings of both innovation and speculative exuberance, the ripple effects are felt far beyond domestic borders. European investors are rebalancing their portfolios in response to low dividend yields, and Asian markets are recalibrating in the face of shifting monetary policies. This interconnectedness means that a decision on Capitol Hill or a surprising earnings report from Silicon Valley can send tremors through the global financial system. It really challenges us to think broadly and act with a global perspective, always asking, how does this change the board on the international stage?
That's so true, John. It's now time to share some expert insights and predictions for the near future. What are market strategists forecasting?
Many are forecasting a period of moderate volatility in the coming months, especially as the bond markets recalibrate after the Treasury's recent move. Some experts believe that the rising liquidity, courtesy of increased T-bill issuance, could provide a cushion for the equity markets, potentially reducing the severity of any downward swings. On the flip side, the caution surrounding CoreWeave and the bearish calls on Circle Internet remind us that overvaluation in certain sectors could lead to corrections. In my view, what we're witnessing is the market's natural balancing act, a transition where exuberance meets realism. As an old saying goes, this too shall pass, but it always does so while teaching us some valuable lessons about market cycles and risk management.
That's a really pragmatic outlook. You know, you always like to sprinkle a bit of humor into these discussions, John. After all, if we can't laugh about the ups and downs of market vagaries occasionally, life might feel a bit too heavy.
Chuckles. Exactly, Sarah. Imagine the market as a roller coaster. One minute you're cheering at the thrilling heights, the next you're gripping the safety bar during a dip. And yet, despite all the screaming, we all get back on the ride the very next day. That's the spirit of investing. A mix of excitement, trepidation, and the occasional belly laugh when reality turns out to be even crazier than fiction.
Laughs. So true. Before we wrap up, let's run through some key takeaways and thought-provoking questions for our dedicated listeners. John, what are the major points from today's briefing?
Okay, so first, the equity indexes gave us a mixed lens today. Marginal gains on the S&P 500 and Nasdaq, near flat performance on the Dow Jones, and modest growth in the Russell 2000. All of this against the backdrop of strengthening digital asset prices. Second, the U.S. Treasury's decision to increase T-bill issuance and its aim to boost cash balances to $500 billion by the end of July signals a more proactive approach to managing fiscal liquidity.
And third, dividend yields for U.S. stocks in the S&P 500 are approaching record lows, a phenomenon that raises the question of whether the market's focus is shifting toward capital gains at the expense of income stability. Fourth, CoreWeave's stock performance, quadrupling since its IPO, offers a classic tale of exuberant growth tempered by heavy reliance on a single partner, Microsoft, along with concerns about insider selling post-lockup.
Fifth, Circle Internet is under the microscope as analysts. Notably, Mizuho's Dan Dolev suggests that its current market valuation is significantly overstated, with predictions of a near 60% decline to reach what they believe is a more realistic price target. Sixth, from a sector standpoint, technology stocks are at the forefront of growth tempered by risk. Energy companies are in the midst of reconciling short-term volatility with long-term sustainability, and the finance sector is navigating a challenging regulatory and economic landscape.
And finally, seventh, globally, the interplay between U.S. fiscal policies, European bond market trends, and Asian economic indicators demonstrates the increasingly interconnected nature of global markets. As you mull over these insights, here are a few questions to keep you thinking. What might be the long-term effects of sustained low dividend yields on the behavior of retail and institutional investors alike? Will the Treasury's increased T-bill issuance act as a safety net, or could it have unintended consequences for liquidity in other sectors? And in our ever-dynamic tech space, could the heavy dependency on giant partners like Microsoft cause a significant reevaluation of company valuations if their growth slows down or if shifts in policy occur?
Those are fantastic questions, Sarah. I encourage each of you to not only reflect on them, but to also engage with us. Our AI Copilot is always available for follow-up insights, so feel free to reach out with your thoughts, observations, or even those aha moments that can only come from a deep dive into the market's intricacies.
In closing, today's briefing has taken you from a detailed market overview through deep dives into key sectors and headline stories, right up to the broader global implications at play. Whether you're reviewing portfolios, plotting investment strategies, or simply staying informed as part of a lifelong learning journey, remember that every piece of data, every headline, carries a story of risk, opportunity, and resilience.
I want to thank you for joining me on this journey today and for trusting Pantheon AI as your information co-pilot. As we wrap up, consider how these trends might shape your next trading day or investment strategy. Could the interplay between expansive digital asset markets and cautiously optimistic Treasury moves redefine traditional market structures? Only time and keen observation will tell. And if you found today's session thought-provoking, just wait until tomorrow. I promise there will be plenty more insights, fresh analysis, and yes, even the occasional chuckle at the quirky turns our markets take.
Remember, learning shouldn't feel like a full-time job. We invite you all to come back for the next episode tomorrow, and as always, feel free to ask questions to our AI co-pilot whenever something piques your curiosity. Until next time, take care, stay curious, and keep thriving in this ever-evolving financial landscape. Pantheon AI, your information co-pilot.
Because learning shouldn't feel like a full-time job. Take care and see you next time.